So you're entering retirement and you want to avoid the tax on the Social Security check. You see, the average American today is receiving over $20,000 to $30,000 a year in Social Security, but unfortunately, the IRS and Social Security is forcing you to pay taxes on this money. So today we're going to be talking about the steps you need to be taking if you want to get this check and avoid paying the tax. My name is Sebastian Guerra, president and partner here at Guerra Wealth Advisors, where we help families get to the point where work becomes an option and not an obligation. And today we're going to be talking about all of the steps you should be following to avoid tax on Social Security. So we ended up meeting with a family. Her name was Martha, husband's name was Bart. They were both 66 years old, and they had just recently retired. They were already getting money from Social Security. He was going to be getting about $3,000 a month. She was going to be getting about $2,200 a month, for a grand total of about $5,200 a month coming from exclusively Social Security. Now, they had this goal and they had this mission that they wanted to be able to spend about $9,400 on a monthly basis from all of their income, and they wanted to be able to pay the least amount of money in taxes on this money. Now, if you looked at all of their accounts, they had at bank accounts, they had about $1,600. They had a Morgan Stanley inside an investment account about $300,000, and then they had a traditional IRA with about $250,000 for a grand total of about $710,000 that they had between all of their investment and retirement accounts. So the question is, how are they going to be able to take money out of their investments and at the same time retire and not have to pay taxes on their Social Security check? So the first thing is we need to look at what their total expenses are. As we just spoke about, it's going to be a total of about $112,000 per year. We also know that Social Security is about $5,200 for a grand total of about $62,000 a year, which means that they have what's called an income gap of $4,200, which, by the way, if you right now are entering retirement or you are already in retirement and you don't know what your income gap is, it's probably one of the most dangerous things that you can do as you're entering retirement, which is you have a certain amount of expenses and you're pulling money out of your savings, out of your retirement. But the question is, how long is this money going to last? So it's a very important exercise that we should all be doing, especially as you're getting closer to retirement, which means that there's an income gap of about $50,000 a year. So now where in the world are they going to start pulling those $50,000 a year from on a yearly basis, and at the same time minimizing the tax on Social Security? So the first thing that we need to know is we have to understand how Social Security today in America gets taxed. So I'm going to try to break this down as simple as possible. So before we get into the whole topic of how to avoid paying taxes on Social Security, I think it's first important to understand how most of America is going to have to pay taxes on their Social Security check and how the government decides on calculating who they tax and who they don't tax. Now, the answer is it all depends if you are filing as single or as married. And then what they go and do is that they go and look at something called provisional income. And there's two things that they're looking at, right? If you're a single individual, they're going to look at something called AGI, your adjusted gross income. Then they're going to add up all of the money that you're making from Social Security, and then what they're going to do is they're going to divide it by 2. So if you're getting in Social Security, call it $30,000 a year, they're going to just divide that by 2, in other words, 50%, and that means it's $15,000 is going to be added to your adjusted gross income. And then they're going to grab any tax-exempt interest. So for example, if you're getting interest from like municipal bonds, then that would be considered also part of your provisional income. So the first thing you want to do is, what is your AGI? What's 50% of your social? And do you have any tax-exempt interest? Primarily municipal bonds. Now, whatever number that gives you will now determine if your Social Security is going to get taxed. So now let's move over here. So if you are single and your provisional income is less than $25,000, in other words, between $0 and $25,000, your Social Security check will not be taxed, okay? So if you're getting, say, $10,000 from work and maybe $10,000 from half of your income from Social Security, that means it's $20,000. That means your Social Security check will not be taxed. Now, once you go between $25,000 and $34,000, 50% of your Social Security check will be considered taxable. Now, remember, that doesn't mean that you have to pay 50% in tax. What that means is 50% of what you made from Social gets taxed. So if your Social is $30,000, half of that is $15,000. That means those $15,000 will be taxed. Hopefully that makes sense. Now, if you are above $34,000, again, as single, not as married, If you're above $34,000, then 85% of your Social Security check will be considered taxable. So if your Social Security check is, say, for example, $20,000 for the entire year, then grab 85% of that, which is about $17,000, and that now will be considered as taxable for you. So the question is, how do I go about withdrawing money and avoiding the tax? Well, let's now get into if you're married. Well, if you're married, if it's less than $32,000, then you don't pay any tax on that. But if you're between $32,000 and $44,000, again, as married, 50% of it gets taxed. And then if you are married and it's above $44,000, your provisional income, then 85% of it gets taxed. So that is the way the government decides on who they tax when it comes to Social Security. So since those are the rules, now the question is, how do we play the game following the rules? And if we know the rules of the game, we can now take money out from the right locations and avoid paying the tax. And that's what we're going to talk about right now. How you can now start withdrawing the money from your retirement accounts, from your investment accounts, and avoid taxation on your Social Security check. So by the way, if you're right now an individual that is planning on retiring over the next couple years, or maybe you're already retired and you're trying to figure out strategies on how you can pay less money in taxes, especially as it pertains to Social Security or the withdrawals that you're taking from your retirement accounts, you can click on the link below and you can book a free session with one of our wealth advisors. What they'll do is they'll sit down with you and they'll actually map out a full detailed plan on how much you should be withdrawing on a monthly, yearly basis from all of your accounts so that you're paying the least amount of money in taxes. The problem is that many people, they'll just start withdrawing money out of accounts, but they're really not thinking about what's the most optimal way to withdraw money so that they're paying the least amount of money in taxes. So if you're interested in booking that session, just click on the link below. As we mentioned earlier, we said that this family was going to have a gap of about $50,000 a year. Remember that that's the amount of money they now have to pull from their investments in their retirement accounts to pay for all of their expenses. Because remember, their expenses was going to be over $9,000 a month, and their Social Security check wasn't even going to be covering that. So now they need to go take out $50,000 from their account. So the question is, where do they pull the $50,000 out from on a yearly basis so that it doesn't get taxed? So usually most people, they have three types of tax buckets. There are accounts that are already taxed. So those are normally things like checking accounts, savings, CDs, money markets, and brokerage accounts. You see, these accounts, they've already paid taxes on it. Now you have accounts that have never been taxed. So things like 401ks, 403bs, IRAs, TSPs, 457s. These accounts, they've never paid tax. And as you can see, they have $460,000 in checking, savings, CDs, money markets, and brokerage, and then they have $250,000 in these types of accounts. And as you can see here, they have no money in any accounts that are tax-free. So normally things like Roth IRAs, municipal bonds, and cash value life insurance can be used as a tax-free vehicle. But in their specific case, they had no money in tax-free accounts. So now your question is, how are they going to now be able to take money out of their accounts and avoid the tax? And it all has to do with where they withdraw the money from. So in their specific scenario, they said, all right, well, I know I need to take out $50,000 out of my accounts. Well, if they go and take out $50,000 out of this category, then there's not going to be any tax paid at all on their Social Security check. But look at what happens if they go and they now take money out from their retirement accounts. Well, if they took out the same $50,000 instead of taking it from the left buckets, but they now moved it over to the middle bucket, then now that means that on the $50,000 withdrawal, they will now have to pay about $6,000 to Uncle Sam just simply because they pulled the $50,000 from the wrong account. Here's another option. What if instead of taking out those $50,000 from just one account or just the other account, what if you created a blend? What if instead you took out $25,000, call it from bucket number one, and then you pulled out the other $25,000 from bucket number two? Well, in this scenario, they still end up paying in taxes, but look how much money they end up paying. They only pay $817 in taxes when they create a blend of both. So what it does is that it now allows them to still take out the same $50,000, but they're paying way less money in tax because they did something called strategic withdrawals. So one of the problems that many people have as it pertains to their retirement is that they have all of these accounts. They have an IRA, they have a 401k, they have a Roth IRA, they have bank accounts, they have brokerage accounts. They're now entering retirement and they're kind of like confused on, okay, I need $50,000 a year to pay for my lifestyle, But where am I going to now take those $50,000 a year from? And if you are very strategic on where you're withdrawing this money from, year over year, you can literally save tens of thousands of dollars, if not hundreds of thousands of dollars, throughout your entire retirement. So it's not as easy as just saying, hey, I'm just going to pull the money out from the first account that I see. It needs to be very well thought out, because if you pull it from the wrong location, it can cost you a lot of money in taxes. So if you know anyone that's planning on retiring over the next couple months or maybe the next couple years, and they're really interested on minimizing the taxation on their Social Security benefits, don't forget to grab this video and go ahead and share it with them. I think it's very important that we learn this information so they can be in a better position. Take care.